The market for annuities. Economists and non-economists tend to view annuities quite differently. Economists have for a long time wondered about why annuities aren't more popular in countries such as the US, where they're not required. After all, we buy insurance against our health deteriorating or against damage to our houses and cars. So why do more people not buy annuities to insure against outliving their assets? To try to understand this question, let's look at some prices for annuities. According to the website immediateannuities.com, for a 60-year-old man, $100,000 in March 2013 as a lump sum bought a payment of $479 per month for the rest of his life. That price is an average price over what many insurance companies are offering. For a 60-year-old woman, it will buy you a payment of $450 for the rest of your life. Why the difference? Well, women typically live longer than men, and the insurance companies selling these products know that and construct their products accordingly. Another observation is that the older you are, the greater the monthly payment the insurance company will offer you for your money today. Why? Well, because the older you are, the shorter your remaining period of life expectancy. Think about it. Suppose the insurance company is at least breaking even on the annuities it is selling to 60-year-olds. The company would then make outsized profits if it promised the same payments to someone who bought the annuity at age 75 in exchange for the same amount of money, say $100,000, since in expectation, the insurance company will be making fewer payments to the person who buys the annuity at age 75. Since the industry is at least somewhat competitive, an insurance company that tried to offer the same payment to someone who is age 75 as someone who is age 60 would not have very many age 75 buyers. Now, many people do not have a positive first reaction to these prices. It seems to entail giving up an awfully large amount of money up front in exchange for relatively small monthly payments. Besides, what if I buy one of these and then get hit by a bus tomorrow? You might say it doesn't matter because I'll be dead anyway, but many people would like to think that if that happened, their children could receive a windfall of the unspent retirement money. Not so if you bought an annuity, and in fact, that's one reason to suspect people might not like annuities. But if you're worried about dying tomorrow, a related product many insurance companies offer is a life annuity with a certain number of years payment guaranteed to you or your heirs, even if you die. For example, here I've added prices from March 2013 for a life annuity with a guarantee that at least you or your beneficiaries will receive 10 years of payments. These products have lower monthly payouts, of course, and despite the 10-year guarantee and the fact that many economists believe that people should buy more annuities, most people still don't find these annuities very enticing at these prices. Another complication for life annuities these days is the fact that in an environment where interest rates are low, it is expensive for the insurance company to provide these payments. That's because the insurance company is largely trying to buy bonds that will match these promised cash flows. Since bond yields are so low, the insurance companies offer lower payouts for a given amount of money, say $100,000, than they did when bond yields and interest rates were higher. To see this, here are single premium annuity rates from immediateannuities.com going back to January 2003. You can see that $100,000 today will get a 65-year-old man $522 per month for life, or a 65-year-old woman $491 per month for life, with at least 10 years guaranteed. But back in 2003, it bought $575 to $625 per month for the woman, and $600 to $650 per month for the man, depending on what month the annuity was bought in. What is the other line in this graph? That is the yield that you can get on very safe corporate bonds. Those are bonds that are not quite as safe as U.S. Treasuries, but close. And you can see that there is a tight relationship here between the bond yields and the annuity prices. So in looking at these prices, you also have to ask, what is the alternative if you want a safe return, which these annuities definitely offer? The alternative is saving your money in safe bonds, and these also offer much less attractive yields than they used to. So relative to bonds, it's not at all clear that annuities offer worse payouts than they used to. Setting aside the fact that interest rates are lower than they used to be, and therefore that many financial assets look expensive, it would still be nice to understand why more people in the U.S. don't buy annuities. Economists have many hypotheses for why people often have a negative reaction to annuity prices. Here are some of them. Perhaps consumers have some aversion to annuities because there are markups in prices. In other words, consumers may believe that insurers are earning economic profits off of them. And indeed, some recent academic research suggests that outside of the financial crisis, insurers have been receiving markups of perhaps 5 to 10% on their life annuity products. Alternatively, perhaps people don't like annuities because they have bequest motives. That is, they want to leave inheritances to their children, which an annuity precludes. Or perhaps people want to have liquid funds in case of an emergency, so that there is a precautionary liquidity motive. Yet another explanation is that there is adverse selection in annuity markets, and that the only people who buy annuities are ones who will have some good reason to believe that they will live for a long time. Everyone else then stays far away from the annuity market because they know it will be a bad deal for them. Another possible reason annuities are unpopular is that perhaps people just undervalue the longevity insurance. They believe they will not live as long as they're likely to. And a final reason is that it's difficult to feel comfortable about writing a big check to an insurance company. You might fear what happens if the insurance company itself runs into financial difficulty. Some of these fears are irrational, as there are state protection funds for insurance companies and for these products. But nonetheless, worries about this so-called counterparty risk will persist. The bottom line is that life annuities provide longevity insurance, which economists generally view as valuable. But people don't usually have a positive reaction to annuity prices. The reasons for that are an active topic of academic research. Suffice it to say, most economists believe individuals should be buying more annuities than they are.